Now we move into one of the most important concepts in capital budgeting, time value of money. The time value of money is the idea that a dollar today is worth more than a dollar in the future. A dollar today is worth more than a dollar in the future because money received today can be invested to earn interest. The time value of money assumes that cash flows occur at the end of the year, interest rates are constant, and cash flows are reinvested at the same rate. These are simplifying assumptions, but they allow us to compute present values and future values. Let's talk about those key terms. Present value is the value today of a future amount of money. The future value is the value of money invested today after earning interest over time. Compounding is earning interest on both principal and accumulated interest. These concepts are essential in capital budgeting because companies must discount future cash flows into today's dollars. Let's take a look at the power of compounding. Imagine a situation where you invest $100 at a 10% rate of return. In year one, you would generate $10 of interest revenue and have an ending balance of $110 at the end of the year. In year two, your earnings are not on the $100 of initial investment, they're on the investment plus the additional earnings that were added to the balance. So now your earnings are based on $110 at a 10% rate of return for interest revenue of $11. That continues over time, and your interest revenue on an annual basis continues to grow. Discounting is the process of converting future cash flows into a present value, so we're going the opposite direction. We do this by using present value factors based on an interest rate and a number of years. Discounting is important because it allows us to compare cash flows occurring at different times in a consistent way. Let's examine the previous example, but let's work it backwards from the future value back to the present, using the discount rate based on 5 years of return at a rate of return of 10%, illustrated on the previous slide. That discount rate is 0.621. Let's use that to discount $161.05 back 5 years to the current value. If we take that future value of $161.05 times the discount rate, we would end at $100 of current value. That's the opposite of the previous example, where we invested $100 at a rate of return of 10% for 5 years and arrived at a future value of $161.05. Now complete learning activity 8.4. You are asked, what is the present value of $100,000 received in 8 years at 15% rate of return? How many years must $5,000 grow at a 10% rate of return to reach $9,750? And third, what interest rate is required for $1,000 to grow to $2,000 in 5 years? Use the present value and future value tables in your book to solve each question. Pause here and work through the activity. Once you've finished, check your answers with the solutions provided in the back of Chapter 8. Now we introduce annuities. An annuity is an equal series of cash flows over a period of time. In capital budgeting, many investments produced annual cash inflows that are consistent each year. So we often use present value of an annuity factor to compute the present value of a stream of cash inflows. Figure 8.8 shows a present value of an ordinary annuity of $1 at various interest rates and time periods. Now complete learning activity 8.5. What is the present value of an investment that returns $10,000 annually for 7 years at a rate of 10%? This is a present value of an ordinary annuity problem. Use the annuity table to find the present value factor for 10% and 7 years, then multiply by $10,000. Pause here and work through the activity. Once you've finished, Check your answers with the solutions provided in the back of Chapter 8.